Good evening, everyone. Time for another silver update. We're going to start off tonight with the blog and a posting that I did, Fed mission accomplished, silver down, Dow flat. Got a lot to cover tonight, so I'm going to talk fairly fast. The chart that I've got here that I put on the blog, this is a chart of silver. You can see the opening on silver. The New York opens around 8:30 a.m. You can see we had a massive sell-off in silver. It wasn't as large in gold, but it was fairly large. So we had a massive sell-off coming out of New York, and they moved it almost $1. That's a real common occurrence if you follow the silver market. It's not uncommon at all to see silver move $1 or more in a very short span of time. Of course, if that happened to the Dow, as I pointed out before, there'd be all kinds of investigations. And we're going to look into some of the investigations that are going to go on with what happened today in the stock market. But so you can see that with the Bernanke dud today, everybody was waiting for some kind of QE3 or some kind of hint at QE3. There was nothing at all. And of course, silver then turned and sold off again. And you can see the Dow up here, it sold off a little bit, and then it pretty much closed flat. A little bit lower, but so again, that was mission accomplished. They managed to crush the precious metals and support the paper, and of course that's their game. That's their game plan for a long time, and that's to discourage you from investing in real assets and encourage you to invest in fake assets. Now, before I get to the main story of the night, which is going to be Dark Knight Capital, which occurred this morning with a second flash crash, I want to jump over to a numismatic play. Now, this is one that I have not taken advantage of. It's just one that I'm featuring, and I'm not making any investment recommendations, so don't get me wrong, but I'm just covering something that I thought was kind of a mispricing, and this is an eBay deal that I found. I often check the coins that I've invested in on eBay, especially on the completed auctions. Now, to get completed auctions on eBay, you have to have a login. You have to log in, and then you have to search completed auctions to see the prices actually paid. This is an auction that is a buy it now auction, and you can see that this is an auction for 20 of the Silver Dragon Lion Privy. Now, I did a little bit of research on this. Don't quote me on it. This is what I found. After the Perth Mint originally issued the 300,000 of the 1 ounce dragons, and those were those were a very in-demand issue. They're on APMEX right now for about 75. They're on Gainesville for 78, I think. And this Dragon Privy was a secondary issue they came out with, caused a lot of controversy. There's a thread on Silver Stackers Forum if you want to read that goes into it. But this one has the Lion Privy mark. You can see right here, there's the Lion Privy. And this is a Perth Mint issue. This one is a 200,000 issue. You can see that this gentleman is offering rolls of 20 for $1,100. So you're getting them for 55 bucks. And the Lion Privy is 100,000 less in the issue. So that's one. I don't have any dry powder at the moment, so that's one that I thought, in my opinion, for the numismatic only, this is certainly not for any kind of bullion stackers, because $55 is a long ways away from spot. So don't misunderstand what I'm saying here. This is just, in my opinion, a possible mispricing. And you can see there's 5 rolls of 20 available, which I believe is a box. And he's offering a special price on the box if you want to get that. So that's an interesting find. And you see that sort of thing, mispricing in a thin market. And of course, we're going to look at thin markets and thick markets when we get to the main story. And that is going to be what happened with Knight Capital. Now, this is a story from Zero Hedge. And this one came out this evening. The facts are still being assessed. We don't know what the real facts are on this story, but it appears to be another flash crash, or not necessarily a crash, but an algo blowout. And let me read some of the story here and comment. We all know something went horribly wrong in various New York Stock Exchange traded stocks today between 9:30 a.m. and 10:15 a.m. So wrong, in fact, the New York Stock Exchange had to step in and cancel numerous trades in 6 symbols. Now remember that. They only canceled 6. However, it did not DK. That means don't know. If you've been in the brokerage business like I have, it just means you back away from a trade. You say, I didn't know. I'm not responsible for that trade. Did not DK millions of other trades and 134 other symbols, the vast majority of which we assume traded errantly due to the market making of Knight Capital, as admitted by the company, which today saw its biggest drop ever since going public on volume about 60 times greater than its average. We also know that one should buy low and sell high. At least that is what human traders are taught, and that is what they attempt. Because if one consistently does the opposite, one will simply run out of money. Well, the opposite is precisely what the berserk algo in Knight's market-making group may have done if Nasdaq, which has done a forensic analysis of one of the trades in question, is correct. In other words, instead of at least attempting to provide liquidity via limit trades, Knight's algorithm acted as a market order gone horribly wrong, as the third chart below shows. What the algo did with furious repetition and steadfast consistency was to buy at the offer and sell at the bid. In other words, buy high and sell low. Over and over and over, as Nasdaq laconically notes, quote, in the case of EXC, that means losing about 15 cents on every pair of trades. Do that 40 times a second, 2,400 times a minute, and you now have a system that's very efficient at burning money, end quote. Which also means that by not decaying several hundred million prints, the New York Stock Exchange may have just thrown Knight under the bus, because the market maker is suddenly on the hook for tens, if not hundreds of millions in inverse market making profits. So remember that Knight has just been thrown under the bus. Here we will assume that readers are sufficiently familiar with market structure to know that market makers only participate in the market in order to collect liquidity rebates, i.e. to be the limit on the bid which is hit or the offer which is lifted. What Knight did was effectively the opposite, and also collected the opposite of a rebate, i.e. it paid someone else for no reason at all, well, technically to withdraw liquidity. However, liquidity that led to creation of losses, not profits. Naturally, when the entire logic of trading was perverted courtesy of Knight's busted algo, everything went bizarro day and stocks went higher, because they went higher, and the higher they went, the greater the incentive for the algo to keep pushing the stock higher. This explains not only the volume surge, but also the shocking price moves in some stocks, such as China Cord Blood, and I don't even want to go into that. You can look that up. That's a company that trades in umbilical cords or something. That's crazy. Which exploded several 100% higher before someone had to finally step in. And what is most notable is that because there were neither fat finger trades nor busted algos that took out the entire bid or offer stack in one trade, thus triggering circuit breakers. Remember that. I'm going to get back to that. But a slow methodical bleed. There was no reason under the current SEC order cancellation methodology, and we're going to look at that, to bail out Knight and its berserk algorithm. Simply said, today may be the single worst day in Knight's market-making history, and sadly, as the New York Stock Exchange already noted minutes before the market closed, the decision to not cancel any more trades is not subject to appeal. So we have the New York Stock Exchange and the SEC. Now, I don't have the article cited here, but you'll have to take my word for it and do the research yourself. The 6 trades that they busted, that they reversed, were trades where the price traded more than 30% either up or down from the opening price. Now, there were 6 stocks that they China Cord was one. There was Wizard Software and some others. You'll have to do the research yourself. But another one of those stocks that was affected was Radio Shack Corporation. And you can see this is on bigcharts.com, and you can see the massive volume here that came in. Most of it was at 9:30, but you can see even after that time, at from the early 10 to 10:30 hour, there was massive volume in Radio Shack. You can also see that it opened pretty much within the close. I believe the close yesterday was about 292. This chart isn't quite right, but it's close. And the open was at 293. You can see open was 292, high was 367, low was 265. Now what's interesting about this is if you do the math, and I did it on a calculator, you can do it yourself, it comes to about 25%. If you look at the opening price and the high price, there's about 25%. So this stock, even though it was affected by these crazy algo, massive computer buy-sell orders that came in furiously, that drove the price up massively into a spike, then crash, then spike, then crash. And you can see it closed at about 2. The close was, last was 280. So pretty much just sideways motion if you go from beginning to end. But there were a lot of people who took a huge bath in this stock. It went up 25% and then crashed as much dollar-wise, percentage-wise more, and then came down. So the big question is with this stock is, well, there's a lot of questions. First, what is the SEC's rule, or the New York Stock Exchange's rule, for breaking trades, and how does that help anything? In other words, if they only break trades that go beyond 30% of the opening, but you have trades like this where option traders are blown out and other traders are blown out, what good does it do? Doesn't that just show you that the entire system is broken? And I think that's probably the meaning behind the dark night. But let's look at some articles relating to Knight Capital, and I pulled them. I'm going to start off pulling them in order here. Now, if you remember, the Facebook IPO was a big controversy because we had a similar glitch, a delay glitch, when the stock initially IPO'd. And one of the stories that came out in regards to that IPO was related to Knight Capital. And this is one that was carried on Wall Street Journal. And this was back on the 4th of July. And it's called A Nasdaq Critic Takes Aim. And it's Jenny Strasberg. Settling into his seat last month at the witness table in a congressional hearing room was Thomas Joyce. Thomas Joyce leaned forward, the man on his left, and said, "Don't elbow me." The 57-year-old Mr. Joyce, who runs stock trading firm Knight Capital Group, Inc., was warning Duncan Niederer, chief executive of New York Stock Exchange Euronext, to brace for a squabble over the future of the U.S. stock market. Likewise, Mr. Niederer shot back. Both men grinned. Lately, Mr. Joyce, known as TJ, has reserved his sharpest jabs for another exchange executive, Robert Greffield, head of the Nasdaq OMX Group, Inc., who oversaw Facebook Inc.'s IPO, controversial initial public offering in May. A former Merrill Lynch and Company executive, Mr. Joyce isn't above scrapping with the exchanges his firm pumps millions of orders through daily, or breaking with the party line of his peers in the world of high-frequency trading. Since May 18th, the Facebook IPO has brought long simmering tensions to the surface in a market already under heavy scrutiny. That day, technology problems plagued Nasdaq even before Facebook shares opened for trading. Mr. Joyce soon emerged as one of the most outspoken critics of Mr. Greffield's leadership. Quote, "This is just business," Mr. Joyce said. I think he may end up regretting that statement. Bob Greffield is a nice man, but I think his organization failed on several fronts. Mr. Greffield declined to comment through a spokesman. Mr. Joyce became one of the first major brokerage firm executives to blame Nasdaq's glitches for losses, which Knight has estimated at $35 million for the firm. Since then, he has lambasted the exchange group's plan to compensate for the loss claims related to the IPO. By the way, in other research I did, it turns out the Nasdaq is only on the hook for about $3 million in damages. The damages with Facebook IPO could be as high as $1 billion and even higher. Last month, Nasdaq said it would seek SEC approval. Here we go. Here's the porno surfing regulators here at the SEC. SEC approval to pay out $40 million, a fraction of the $500 million or so in total losses estimated by Wall Street firms. Nasdaq has been in discussions with the SEC, Nasdaq, and the SEC about the plan, while brokerages await details that could come in a regulatory filing by next week. Knight said in a May regulatory filing that it was evaluating all remedies available under law to recover its Facebook IPO losses. So Knight was preparing to sue the Nasdaq. Nasdaq's technology problems on the exchange delayed the start of trading in Facebook shares by half an hour until 11:30 a.m. for nearly 2.5 hours. Nasdaq wasn't sending out trade confirmations, making it impossible for firms like Knight to sell their clients what they had bought or sold. At 12:01 p.m., Mr. Joyce shot Mr. Greffield an email urging him to halt trading in Facebook shares. According to a person familiar with the communication, Mr. Greffield didn't write back. About 3 hours later, Mr. Joyce called Richard Ketchum, head of the Financial Industries Regulatory Authority, Wall Street self-regulator, and told him the industry was getting crushed. So you can finish the article. I'll link it in the comments below. Now, that's very interesting that Knight has now been destroyed. You draw your own conclusions. Now, this is another article. This is from the Wall Street Journal, and this came out on the 24th. This is an update. Knight Capital is likely to back the Nasdaq plan for Facebook compensation. So Knight signed on. Now, remember that Knight was alleging they'd only lost 30 or so million. Knight Capital likely to back the Nasdaq compensation plan. Remember, I pointed out that Nasdaq is really only on the hook for about $3 million. That's the legal limit they're on the hook for. Knight is expected to show its support in a letter filed with the SEC. Better be careful about filing a letter with the SEC. On Friday, Nasdaq increased to $62 million, the amount of money it plans to pay back brokers. I think that makes about half of that. Knight reported 35.4, so they would get about half that money. And then we get another wrench thrown in the works, and that's UBS. Now, this story came out yesterday, and this is UBS's huge Facebook loss throws doubt on the Nasdaq plan. Reuters. Facebook's disastrous May IPO took on a new dimension on Tuesday as Swiss bank UBS said it lost more than $350 million on botched order execution and would take legal action against Nasdaq for the exchange's alleged failures. But UBS did not fully explain why its losses were 10 times worse than other market makers, raising questions about how much liability Nasdaq could actually face. Meanwhile, Facebook shares fell to a new all-time low Tuesday, touching 21.61 in afternoon trading. At that level, they were down 52% from their first day high. UBS's $349 million Swiss franc loss dwarfs the $62 million all-cash plan Nasdaq set up to compensate customers who lost money because of the exchange's technical problems. Technical problems, okay? So Knight Capital was leading the charge against Nasdaq for their technical problems, and then lo and behold today, the stock market, New York Stock Exchange, crashes on algo trades due to technical problems which are blamed on Knight Capital. So, and I'll link these stories. You can read the rest of these. There's a lot of stuff to follow up on, but I wanted to take you to another story, and I think that's going to connect the dots here, and that is the story from India. Now, this is the dark night in India. If you haven't seen the story, I guess you haven't been reading the news, but basically India went into a blackout. This picture on the right is from the 23rd of July, and this shows you the electrical grid in India. And then the picture on the left is a picture from the 30th, and you can see India pretty much, except for, I don't know, maybe these are some of the outsourced tech houses that have their own power. Maybe Hyderabad, I don't know where that is. But anyway, you can see that we have a very dark night in India. And the question is, anyone who is rational and logical would ask is, who in the world would link all of these systems together without, and you remember the term we use, circuit breakers. We're talking about the Knight Capital trades that spread, the algo trades that spread and crashed the whole system. So you have this crash in India of the electrical grid, and one would logically ask, why were there not circuit breakers that were at least connecting the circuit breakers between these different areas in India, that if one went down, it would trip the breaker and it wouldn't cause the others to be overloaded. That's just common sense. Anybody who has a brain would design a system like that. Well, the same thing is the case with Knight Capital. The question is, how is it that a firm as tiny as Knight Capital, you can go on to Yahoo or CBS Market Watch, look up their capital. They have about $5 billion in debt, about $750 billion in cash. I'm not sure what their net is, but they're a very small company. So the question one would ask is, how could a tiny company like this take down the entire system and, of course, cause trades like this Radio Shack trade, which isn't going to be reversed? So there were a lot of traders blown out to the upside and the downside. And how did that type of thing occur? Just as how could such an event that happened in India occur like that? Well, it's, in my opinion, not a coincidence that we have a Dark Knight and Dark Knight Capital, and we'll have to throw in Dark Knight the movie. So the main issue is going to be financial markets and how they operate. Obviously, the regulators are asleep at the switch. It's pretty clear that the regulators have no intent and never really have had any intent of guaranteeing the safety of these markets. The only protection that you have, as Ann Barnhart has stated, is investing in something that you can stand in front of with a shotgun, or whatever term she used, and defend it. If your investment is in a piece of paper that can be evaporated in one morning, or evaporated and then resuscitated, and then have the SEC tell you that, well, it didn't meet our threshold, so you're out of luck. It's a big rigged game, and I think that a lot of people have mentioned that the powers that be often send signals that indicate what they're going to do in the future. I can't imagine a larger signal that could be sent than the signal that has been sent about Dark Knight Capital, is that investing in paper assets is a fool's game, because it can literally evaporate at the flick of a circuit breaker. And we'll talk to you next time.